and it's 12 now, so I'll go ahead and get the webinar started. Robert, if you can hear me, I'm going to go ahead and open up to the public, and I'll do the introductions, which will give you time to kind of sort out some things on your side, and then of course I'll ask you to start sharing. Are you able to confirm that you hear me? Okay, we'll go ahead and we'll work it out as we get it going. All right, gentlemen, let's go ahead and open up the webinar. I will full screen this, and I'm opening it up to the public now. Okay, welcome everybody to the 2022 WOW event. We are getting ready for you right now, so you are in the right place, and we are excited about the next 3 days of presentations that you will get to see. So today we have a topic, a couple of presentations on the topic of adopting cryptocurrency and the future of finance, I suppose. And then tomorrow we're talking about the future of the workforce. And then on Friday, we're talking about the future of governance and governance of artificial intelligence. So the entire series is meant to be thinking of the future and looking forward to the future. So as we get started on this Future Forward series of presentations, we're excited to have you along with us. So for today, there will be these two presentations that we're looking forward to sharing with you just in a moment. My name is Rob Valdez, and I'll go ahead and get us started with some very brief introductory information before we move into that first presentation. So what I have on the screen right now is the agenda that includes all 3 days while I do these welcomes and introductions. And this agenda, of course, is covering the adoption of cryptocurrency on the first day, the future of work on the second day, and governance of AI on the third day. So you can see here all the presentations. There have been some very small changes at the last minute to kind of accommodate some unexpected scheduling adjustments, but we will go ahead and make sure that we provide to you an excellent series of presentations in the next few days. So as I said, my name's Rob Valdez. I'm joined right now by Ryan Barris, who is the Director of Programming. Also behind the scenes, we have Clay Mogenberg, who has been instrumental in getting everything coordinated for this wonderful event. So thank both of you gentlemen for all of your help in getting this ready and getting it started. And then I'd like to remind all of you that this is an interactive Zoom session. So the Q&A module has been enabled, and you can use that Q&A module to write in your questions as the presenter is presenting. And we will go ahead and make sure that we can get those questions asked to the presenter probably towards the end of presentations, but we'll make sure to keep an eye on that. So if you are using the Zoom client on your desktop, that's the best way to participate. However, you can use mobile or in-browser applications as well, and we'll make sure that we address your questions as we go along. So actually, let me be a little bit brief and getting this introduction going so that we can move into Robert Donovan's presentation. So Robert Donovan is a managing director at PwC, and Robert Donovan has a background that is very interesting and gives him some special perspectives, specifically relating to cryptocurrency and information security risk in these with different types of enterprises. So it's our pleasure to go ahead and introduce to you Robert Donovan, and I'll ask him to please begin sharing his screen in just a second. let's go ahead and get it going now. Robert, you should be able to share. And Robert, I can't quite hear you yet if you're speaking. So if you would double check your audio and microphone settings.
Right. Roberto, can you hear me now?
Yes, I hear you. Excellent. Thank you so much.
Thank you. Okay. So thank you for that introduction. As Roberto alluded to, so I'm two things. One, I'm a management consultant now with Pricewaterhouse in the cyber risk and regulatory practice. I spend most of my time thinking about how to help our regulated financial institution clients get out from under regulatory scrutiny, right? So banks, insurance companies, et cetera, that might be subject to enforcement actions with respect to cyber security matters, information security matters. I help them to resolve those regulatory matters. Either A, do the core remediation, and then B, do the or B, tell the story about how they have remediated. So of course, that means I'm, as I said, I'm a consultant. I've got slides. Let's see if I can share the deck. Let's see. Roberto, it seems as though I don't have that ability. Let's see.
All right, let's double check that real quick. And please try again now.
Okay. That work?
Yes, that works. Thank you.
All right, fantastic. So got slides. I do want folks to feel free to have this be as interactive as we can. I'm also a former regulator. So I spent 5 years at New York State Department of Financial Institutions, overseeing New York State regulated institutions. The first 3 years were overseeing large banks that were subject to financial crime risk enforcement actions, overseeing that remediation. And then I moved into a role on top of what was the Capital Markets Division. This is a role that had examiners that would focus on the banking division and the insurance division. So capital markets examiners, of course, but also internal audit and control specialists, cybersecurity specialists, and then also the cryptocurrency function. So folks are familiar with the term BitLicense, which is the New York State special purpose regulatory authorization for cryptocurrency. For 2 years, I was the BitLicense guy. So then the other part of what I do at PwC is help challenger institutions to understand the regulatory environment, right, that they are moving into. So let's see, Roberto, do we have the questions?
Yes, we do.
Okay, let's do the first question.
There we go. You should see a question up on your screen now.
So, cryptocurrency is cryptographically secure and thus invulnerable to compromise. Give folks a few minutes to answer that. We'll wrap it off when we have about, what do you think, about 75% participation here. There we go. So the vast majority of folks say that that's false. That is correct. Let's see. So you're right. Digital assets are uniquely vulnerable to compromise. Security failures have compromised over 100 billion in digital assets by today's values. The thing to remember here is that while the blockchain might be immutable, and quite secure. The ways that we access the blockchain are not, right. It can be just as vulnerable as your browser, your PC, etc. And as such, when we deal with with crypto, with digital assets, we need to bear that in mind. And this is really why we're here today, right? Key paths to digital asset loss, obviously vulnerability, exploitation. So sometimes sometimes the code of the smart contracts is as secure. Private key exposure. So digital assets are really controlled and moved with with the aid of a private key, right? Essentially, very long password. Private key exposure is a key vulnerability or attack vector. Insider theft is huge, so it's a big it's a big risk for regulated financial institutions. All the more so for crypto, because the digital assets are uniquely fungible, and then lack of security controls, right? So the very large exchange, Japanese exchange CoinCheck 2008, suffered, I think, 500 million in losses. There were a number of security failures there. So just general lack of cyber hygiene, right? One of the biggest challenges I think that folks who are active in this space face is they come to crypto, the crypto natives, with a great understanding of cryptography and the promise of the digital assets is the asset brass. They don't necessarily have the same background in governance, risk, and controls that you all would say. Right. Will we share this presentation? Yes, we'll make arrangements for that. And then Roberto, there's a question about credit for the New York chapter.
Got it. Thank you very much. I'll answer that.
Okay, and it looks like a number of folks are saying in the chat that they did not get the question, the polling question. So if you need the polling question, Rob, let's just make a note of that. If the folks need the polling questions for for CPE credit, we'll deal with that administratively.
Definitely. Thanks so much.
Any questions or comments on this slide before we advance to the next? Okay. So we're here talking about crypto and digital assets, and from a variety of standpoints, when we talk about that, we tend to think of it as one asset class, right? Nobody says, I want to get into crypto and stable coins and security tokens, utility tokens. We all just generally say we want to be able to accept crypto, or we want to get into crypto, or we want to understand digital assets. But there are really a whole range of digital assets, right? Understanding them, is key to understanding which ones are appropriate for your business, what the individual risk profiles of them might be, right? And then what the associated controls need to be, for our set of conversations here. Understanding the risks, key to understanding the environment that you need. So I'm just going to go kind of left to right here and talk about the way that some of the assets that you might be familiar with fit into classification. So cryptocurrency, right, is probably what we think about when we say crypto the most, right? So this is Bitcoin, Ethereum, Litecoin, Stellar, etc. This is Bitcoin and Ethereum together make up, depending on the day, between 60 and 70% of the tradable value in crypto, right? So this is really what we think about when we mostly think about crypto. Once you get into it a little bit, next really important category of digital assets to understand is stablecoins. Okay, so Stablecoins are single-purpose exchange of value digital assets that are intended to retain their value with reference to another underlying asset, right? So in most cases, that's a fiat currency like the U.S. dollar, right? So Tether, USDC, Paxos dollar, these are some of the more commonly utilized stable coins. There's a lot of public policy discourse today on stable coins because as they're meant to maintain their peg to a fiat currency like the US dollar, there are some views that monetary policy, maybe. Let's see, just gonna check the questions, comments here. All right, looks like it's mostly. So cryptocurrencies like Bitcoin, you may be familiar with the critique that they do not, that they're very volatile, right? And so that they don't retain, their value as much. Stable coins are meant as an answer to that. Today, most stable coins are used to facilitate capital markets, right? So if you value onto a crypto trading platform to trade into or out of digital assets, usually you need to have some initial funding. That can take a couple days, depending on the platform. To trade into and out of fiat directly, so fiat being cash, US dollar, euro, yen, can that move at the speed with which the bank financial system can move, right? Well, that's pretty good for most things like paying your electric bill, paying your car mortgage, etc. It can be problematic to move value from one platform to another at the speed with which crypto capital markets transactions need to take place. So stable coins are digital assets that are meant to retain the value of a single dollar, a single yuan, single euro. And they're often backed by those underlying assets. In some cases, they can be backed by a mix, right, of fiat, of CDs, money market funds. Some are even backed by mixes that include secured loans, other digital asset tokens. Any questions on crypto or stable coins before we talk about CBDCs, NFTs? Okay. So the next category here are central bank digital currencies, right? So we can have Bitcoin or Ether or Litecoin or Stellar that can transact on a blockchain and be moved peer-to-peer. We have kind of the stable coin, which functions. Think of it as a check written on a blockchain, right? So it's a promise to redeem that for fixed value. In this case, usually a dollar, yen, euro. Central bank digital currency would just be the central bank moving the fiat currency onto the blockchain and using it as a complement. With the Olympics, moving quickly into the rearview mirror, the Chinese government used that opportunity to pilot the digital yuan. It's a CNY here. It's intended as a digital currency to be used for certain concessions at the Olympics, make a big international splash. It didn't quite go the way that folks had wanted. There are a number of other digital currencies, CBDCs, that are an advanced pilot. The Bahamian sand dollar is one, right? So, the Bahamas have issued a digital currency because some 90% of Bahamas citizens have access be able to transact peer-to-peer with a digital dollar as opposed to the fiat, right? So Bahamas consists of several thousand islands. It's really hard to transport currency from island to island. It's pretty easy to send it digitally, right? So there's a range of use cases that are in advanced pilot or launch. Recently, the U.S. government, the Fed, has come out with a thought paper on what a U.S. central bank digital currency might look like. Major features of that are, number one, it should be intermediated, so managed by existing financial institutions. The Fed does not see itself in the business of providing wallets to retail or wholesale business currency. Two, it should exist in complement to, not in competition or to replace existing fiat, right? So the same way that checks or stable coins exist side by side with reserves, that's how they anticipate the digital dollar, the US Cbdc functioning. Also, don't anticipate paying interest on it, and then in an attempt to not crowd out other capital markets activities. Questions, comments on CBDCs, stablecoins, etc.?
Robert, this is Ryan. There's a couple questions that came in. I can go ahead and read them off. So right now, I think we've got 4 total. Can stable coins and cryptos be exchanged with each other as opposed to with fiat currency?
Yeah, absolutely, right. And that's the principal use case for them now. Stable coins are used to trade into and out of positions, capital market positions, and other currencies on major exchanges, right? Both domestically, right? So within the U.S. as well as globally. And so the dollar has kind of a reserve currency function. Globally, it's the leading currency for capital markets trading. When it comes to traditional capital markets, same goes for crypto, right? So if you look at some of the Asian exchanges, the stable coins used will reference the U.S. dollar, and that's used both as means of accounting, right, to determine the value of cryptos, and also as a means to transact and then store value. So we recently experienced a bit of a crypto correction where price of Bitcoin was in the 60s, 70s, down now I think somewhere in the 40s. A lot of folks who have sold off, and when you look at what's happened to the balance of stable coins over that period of time, traded into stable coins. So absolutely, stable coins and cryptos can be exchanged with one another as opposed to fiat currency. That's a major use case.
Okay. Now, the next question is which types do you most commonly see in the U.S. markets?
Okay. So which types of, I'm going to answer this in 2 ways, right? Which types of cryptos? So, the market is pretty concentrated in Bitcoin and Ether. Depending on the day, it'll be between 50 and 60% of total market cap. And then when you add in U.S. dollar denominated stable coins, then you're reaching up into probably the 70s, right? The types of stable coins that you see in the U.S. So there are some stable coins that are issued directly by U.S. state regulated entities. So there are basically 2 major forms that stablecoin issuers take in the U.S. One would be that of a state trust bank. The other would be of a money transmitter. Both of those forms see the issuers holding the assets that back in regulated or insured depository institutions. There's, I think the single largest stable coin by market cap, which is Tether, is registered as an MSB with FinCEN, but there's a lot less transparency around it. That stablecoin asset tends to be traded more frequently in non-US markets, where access to US dollar denominated bank accounts is is more difficult. And I see, Clay, did you have something you wanted to add there, or are we good on this? Okay. I think the next question is around mainstream commercial adoption of cryptocurrency and stablecoins. Are we seeing that, and do you have any examples? So yes, increasingly, what we're seeing are partnerships with between non-stablecoin issuers, stablecoin issuers. So recently, Facebook publicly announced that it was partnering with Paxos to use the Paxos dollar on its platform as a stablecoin. Visa has publicly announced that it's brought stablecoin issuer Circle, which issues the USDC, US dollar coin, into its fintech partnership. And a number of retail entities have announced that they are accepting Bitcoin. I think McDonald's made waves recently by announcing it would accept Bitcoin for payment. Moreover, there are a number of credit card issuers, crypto companies that have started to issue credit cards that will allow you to spend your crypto wherever Visa, MasterCard, etc. are accepted. And that number is only growing. So we see a lot of client inquiry from merchants asking, how can I accept crypto? So I'm going to wrap the next two questions together. What are incentives or reasons to issue CBDCs compared to normal fiat currencies? And is CBDC stable? So again, a CBDC is the digital representation of a fiat currency. So it will be only as stable as the currency references, right? So we're all this is the South Florida chapter of ISACA, right? We all are presumably paid in and carry US dollars in our wallets. From our standpoint, a US CBDC, right, which is the digital representation of the US dollar, would be price stable, right? The USDC, the digital dollar, is not going to necessarily depreciate against the price of a Big Mac, right? Price of the Big Mac will change, right? So we've headed into a bit of an inflationary period in the U.S. economy now, right? It would be expected that a stable central bank digital currency would experience the same price inflation, deflation, et cetera, as the underlying currency. What incentives, reasons are there to issue CBDCs compared to normal fiat currencies? Well, one, you have to transport fiat currency, right? So it might not seem like like a big reason to issue, but when you look at the example of the Bahama Sand Dollar, it's actually part of the compelling rationale for the retail CBDC there. Is it's just hard to transport that amount of currency from one place to another, right? So it is more easily transmittable, transmissible, etc. I can carry a tremendous amount of asset on small device like a thumb drive, right? So it's more easily storable, it's more easily transactable, it's transactable in a digital form, right? Potentially it can provide enhanced privacy, right, over the traditional financial system. And because it may be issuable directly to individuals, it may be able to play a role in enhancing financial inclusion, right? So not everybody, probably everybody on this call has access to a bank account. Not everybody in the US has access to a bank account, right? So the FDIC regularly publishes reports on the unbanked and the underbanked, right? Cbdc could play, a major role in enhancing access to financial systems. Okay. Another question, other than the disintermediation of banks, payment service providers, what advantage does a stablecoin provide over, say, USD, which can be transferred electronically from one person to another? So yeah, USD can be transferred electronically from one person to another with the use of an intermediating service, right? So I can Venmo or Zelle, my babysitter, $50 for watching the kids over the weekend, right? I can do this with my kids, but that's cost there, right? On the application provider. In the case of USD, it would literally be the digital representation of me taking the currency of my electronic wallet, right, which plays a role in how digital assets are stored, transferred, and placing it into Roberto's wallet. Those are the big advantages, right? I mean, I don't know if I answered that question besides the disintermediation, right? I think that there is intermediation in the existing ways in which we transfer electronics. Please feel free to jump back in with clarifying questions. All right, let's see. I see a couple of. I'm going to answer one question here and then go through NFTs and security tokens before I talk about, before I address the question on NFT and exchanges and wallets. Am I using the term fiat currency in the same manner the economist uses the Big Mac? I think so, right? So for those not familiar, the economist has a Big Mac index, right? And what that does is, there are stated exchange rates, right? But they may not reflect the cost of living differentials between and among countries. So the Big Mac index, basically looks at the cost of Big Mac in the US, in Canada, in Europe, Asia, Latin America, Middle East, etc., wherever the Big Mac is served, and uses the price in local currency to derive an exchange rate that it feels may complement official exchange rates from the standpoint of being able to tell you how expensive it is to live in one place or another. So fiat currency, yes. Okay. Next couple questions we have are around NFTs and exchanges and wallets. So let me just talk a little bit about NFTs. So NFTs are non-fungible tokens, are a specific type of smart contract to represent ownership, right, of a unique digital asset. So what do we mean about that? Let's talk about that and dive into some of the use cases, right? So digital assets or NFTs are gaining a lot of prominence as a means to represent digital art, right? So think about any piece of art that you would have electronically. An NFT can be used to represent that ownership uniquely, right? So a typical example that folks think of is digital baseball cards, right? Very very similar in many ways to the assets that you might have on a gaming platform, right? So on a gaming platform, so just World of Warcraft or think about the old Second Life. There are props or skins or devices that users can accumulate, and typically that accumulation is a function of coins or units that are acquired through skill in gaming. Well, you can take that and kind of commoditize it by putting by basically putting those props on a blockchain, right? So that they're not reproducible, they're non-fungible, right? And ownership can be directly demonstrated and actioned on by the user, right? So rather than having a World of Warcraft sword that is only good in the World of Warcraft universe, I may have an NFT that represents that prop, and I may be able to to port it into other platforms, right? So when we think about the conversation around the metaverse, which is online interactive communities, right, where you may want to have be able to represent your avatar with just kind of hair, nifty blazer, fancy cufflinks. Those assets can all be represented by a smart contract on the blockchain, right? There's a range of other use cases. Someone talked about real estate, right? So anything where ownership needs to be non-fungible, right, or needs to be demonstrable as unique, can really be represented by an NFT, and that would include a credential, a leaving certificate from school, a license, or right. So I hope that's answered that question. Then finally, security tokens, right? So security tokens are really just the application of blockchain technology to financial securities. So we all trade. Typically, an equity security is represented by a piece of paper that is then digitized and held in trust by a custodian, and ownership is transferred by a ledger. The barriers to entry to security issuance are pretty high. Over the years, since about 2016, participants in the digital asset space have realized that they can issue tokens that will represent ownership in a common enterprise, right? So that would meet the definition of the how we test in regulatory terms, right? So the same way that you may hold stock in a corporation in your retirement account, that stock could be represented by a smart contract created or managed on the blockchain. I'm going to pause here and read through some of the questions and see if I can organize them. Okay. Are NFTs transferable? Are value of NFT fluctuates? Any trading platform for NFTs? So I'll take that in order. NFTs are transferable. I can transfer my NFT, to Roberto in exchange for something else of value, right? Typically, that might be a cryptocurrency. Increasingly, you can purchase NFTs with fiat equivalent, right? Credit card, etc. So the value of an NFT fluctuates depending on its use case, right? If an NFT is used to reflect ownership in a real estate asset, the value of that NFT would fluctuate presumably with reference to the value of the underlying real estate asset. In the case where it represents digital art, right? Like if it's a digital representation of a baseball card, right? Then it would fluctuate the same way that an art asset would fluctuate. So the player, if it's an early stage career NFT baseball card, and that player then goes on to to great things, be inducted in the Hall of Fame, MVP in the World Series, the value assigned to that NFT would presumably increase. If there's scandal and ill repute, befalls that player, presumably the value would decline, right? So this hits on a real, key concern here, right? So the same way that cryptocurrencies can be volatile, NFTs can be extremely volatile, right? I may pay a lot of consideration for an NFT right? That represents, say, keep going with, the baseball card analogy. You know, baseball card that today is worth a lot, and then if that player, engages in unsportsmanlike conduct, right, and his star falls, the value of the NFT would presumably, fall as well. There are a number of trading platforms for NFTs at present. Most NFTs, as I said, represent digital art use case. That's certainly the one that's gained the most prominence. And as such, art houses are loosely regulated. Digital art houses or NFT platforms are also fairly loosely regulated. The regulatory regulatory collateral around NFTs is fairly sparse. A couple weeks ago, the Treasury Department, the Financial Crimes Enforcement Network, published a paper on art in art use cases in financial crime, and acknowledged the emerging digital art market as a source of concern. So that answers that question. Is there a place for NFTs to document title to physical assets? So this is interesting, right? So we've talked about various use cases. Could an NFT be used to document title to physical assets? Yes. Would that be a function of of state regulation, state law? Also yes, right? So the use case is, I think, well understood, and digital assets have been used to tokenize. To tokenize interest in real estate or common enterprises. There's some work to be done to enable that to happen, kind of on a national level. In the meantime, that's largely been the province of states. Right? Some states like Delaware and Wyoming have been very forward thinking in application of blockchain to more traditional use cases, like documenting title to physical assets. There's a whole industry of title insurers who would probably be concerned if that use case were to advance. Okay, go through for some examples of security. Any use case where they can play a role in regulatory compliance environment. So, security tokens. At present, there's a lot of scrutiny from the Securities and Exchange Commission around digital assets overall, because the commission is of the opinion that many digital assets may indeed have the characteristics of a security, right, of a financial security, and thus be come under the purview of the Securities and Exchange Commission. There are a number of security tokens that are acknowledged as security tokens and are issued in a compliant manner, and that means that they're generally privately issued securities. Use case where security tokens could play a role in the regulatory or compliance environment. Well, certainly, if securities issuance were to be moved over to the blockchain, then you may be able to get better information on who holds what for what purpose, etc. There may well be improvements to price discovery and the like. I think that's probably limited to it. I'm not sure, if there's a compliance use case for security tokens. Certainly for security and regulatory, the blockchain has the ability to be a big tool, right? We already see instances where there's a lot of a lot of use cases that are illicit, right, for digital assets. And we've seen a number of instances where, because of their unique characteristics, you're better able to identify where proceeds of illicit activity have gone, right? So in many ways, Bitcoin is is a attorney general's dream, right? Because in the event that that a crime is committed, that an exchange is hacked, you can trace those assets all the way to their off, right, through the use of financial crime compliance. Would not like to answer what is the most popular site for purchasing NFTs, just because that might be viewed as giving a recommendation. But it's pretty easy. There's a number of major platforms. Let's see. Are you seeing an increase in cryptos as assets backing securitizations being traded in derivatives or other exchange markets? If so, is it a sharp increase or a modest one? So CME, I think it was in late 2017, early 2018, self-certified a Bitcoin future, right? So short answer is yes, right? There's a lot of folks. I think there are Ether futures now that are looking at derivatives, both as a way of managing risk as well as a way of gauging exposure, right? Famously, although a lot of the service providers are regulated, whether they're regulated by the states as money transmitters of trust banks, or increasingly by the OCC as trust banks. So the players are regulated, the markets aren't. What that means is, unlike where the stock of a given corporation will be traded on an exchange. Granted, there are many broker dealers who engage in the process of price discovery. Crypto assets are traded on many exchanges, so the price of crypto assets on one exchange may differ from the price of the crypto asset on the other exchange, complicating price discovery and therefore complicating the mechanism for issuing an ETF, because from the standpoint of price discovery, the regulators are not entirely sure how that should proceed. Which of these digital assets is the most secure? I don't want to call anyone out. I will just generally say that a lot of this stuff is open source. Public blockchains are open source, and so generally the wisdom of the crowd predominates. And from a blockchain security standpoint, the major assets are probably secure. It does happen from time to time that that the code of various smart contracts is identified to have bugs. Then there's a process of gaining consensus around those fixes. So there was a question about wallets, right? And I'll just give quick nod to how these things are transacted. Generally, wallet is a software program that allows you to store the private key, which is what allows you to move the crypto assets from one address location to another. If I use my private key to send Bitcoin to Berto's address, to his public key, then he takes possession of that because he can access that address and control it through the use of his private key, right? Final comments here, with a nod to the fact that Roberto is going to be talking about the El Salvador use case. So on the one hand, all of these require some sort of a wallet, which is a program that allows you to securely store and then send cryptocurrency. Number one. Number two, when we think about these three use cases, ones, twos, threes here on the left, right? and the the way that El Salvador has moved to adopt Bitcoin as legal tender, right? It's really an attempt to mix these first three use cases, right? So one, Bitcoin as a store and means to transact value, right? By identifying or by deeming Bitcoin legal tender for payment of government obligations, right, and obligations in El Salvador, they've de facto given Bitcoin the status of a central bank digital currency. It's a digital currency that's acknowledged by the central bank, right? As to the stability of it, right? Well, there are you can denominate prices of Bitcoin, right? And this may present, as Bitcoin is typically denominated in, in terms of, U.S. dollar or quoted in terms of U.S. dollar, a third country, right, or a second country like El Salvador may derive some benefit from a monetary policy standpoint of acknowledging or adopting Bitcoin as legal tender. It could effectively function in the same way that a peg to the dollar might. So just to nod there and give that, tee that up for our next, next session here. Couple of questions to answer here before we move on. Given the instability related to crypto relative to stable currency, I can foresee significant risks accruing to those paying for securities backed by the debt. I hope that I'm wrong. If not forgotten, 2008, 2010. Absolutely, it's important to note that Bitcoin, the paper was written in the shadow of the financial crisis, right? Bitcoin is a teenager now, just turned 13. Was being developed in 2008, launched in 2009, I believe, and this was right in the middle of kind of the great financial crisis, right? So while store of value as in stable with reference to to U.S. dollar, absolutely. One way that market participants are thinking about crypto, especially in the context of fluctuating fiat values, i.e., U.S. dollar inflation, is potentially a hedge against inflation, right? And especially now in an inflationary environment, a lot of folks are looking at the ability to self-custody, right? So not have to hold your value in a bank, and to be able to move that yourself without having to rely on your bank to follow your instructions to move it, as a real advantage and powerful use cases for this asset class. Last question here: how likely is it that the U.S. Fed will issue a digital currency for broad use? Well, the U.S. Fed has, in its central bank digital currency paper a couple weeks ago, has said that it is thinking about it. Folks on this call may be interested in the follow-up paper, Project Hamilton, that was published by the Boston Fed in conjunction with MIT, releasing code that might be used for central bank digital currency on GitHub. Okay. No open questions on this page. Great audience participation. Thanks a lot. I want to be a little bit conscious of time, Roberto, and so I'm going to try and make not short work, but good work with the following slides. So here, this basically shows the regulatory and market development of crypto over time in parallel. Long story short, back in 2015, 2016, in order to be a regulated player in a regulated provider of crypto services, you really had to be a state chartered entity, right? Over time, a number of other regulatory forms have emerged. So state chartered trusts have emerged. Also, certain states like Wyoming have developed their own, bespoke legal forms that are, tailored to digital asset institutions. And then more recently, the Office of the Comptroller of the Currency has opined that providing services in digital assets is a permissible service for national banks, right? So the National Bank Act allows a national bank, an OCC bank, to provide crypto services, storage, exchange, etc., staking, etc., right? So this also opens the door to state banks, because a state bank can generally go to its state regulator, point to the OCC, and say the OCC is allowing its banks to do, name your banking service. I want to be able to do it as well, and the state regulator will generally have the authority under state law to grant that wildcard. Just the numbers in the quotes are over time represent the number of New York State licenses that have been issued over time. So we go from, there were, just a handful, half a decade ago to 32, including, some entities affiliated with household banking institutions. Okay, move on to the next slide. So storing digital assets is a really important basic consideration for participation in space, right? Not going to go through all these boxes here, right? But this is really kind of the bread and butter of the concerns for risk and compliance professionals. At the end of the day, what you really want to think about from the standpoint of, do you want to get into this, is how, and that's buy, build, or rent, right? Are you going to go to a white label service, or are you going to engage with a service provider to help you, your company, accept, crypto as payments? Are you going to go to a custodian to custody, crypto that you may hold in treasury, right? That's an emerging use case. A lot of large corporates are thinking about crypto as a hedge, right, or as part of a diversified investment portfolio. Do you want to buy the ability, right? So there've been a number of acquisitions in the crypto space recently, or do you want to build it internally, right? And candidly, a lot of folks start out, on the left, and then or on the right, and then move further to the left, right? Decide that they want to dip their toe in, engage with a merchant services provider, and then either will make strategic investments, or use that as a learning opportunity to then build the capability internally. Last question here before we go, I think this probably ticks back to the prior slide. What do you see the U.S. regulatory landscape looks like in 2022, 2023? Who will be the main regulator, SEC or CFTC, with the expected executive order this week? So this is interesting. The presidential executive order on crypto is, as I understand it, meant to be a whole of government document. So it's not just financial services, but what will what will the federal government do, right? Will the federal government enable folks to pay federal income tax on crypto? How will the federal government report to crypto? Not just which player is on first or second. One thing I will say with respect to SEC or CFTC and a main regulator, I know there's a lot of folks who just wish to heavens there could be a single voice for regulatory certainty with respect to crypto assets. That's just not how the U.S. Financial regulatory system works, right? The U.S. has what's called a dual banking system. That means that you can choose whether to be a state-regulated entity or a federally chartered financial institution. You've got state banks, you've got federal banks. There are some federal banks that provide payment services. There are some, payment services that are provided through state options. So recall the earlier slide. A couple years back, you could really only be in crypto if you held state MSB licenses, then came the state trusts, then the bespoke trusts, and now pretty much everybody's game. There's a lot of there's a lot of overlapping regulatory reach here, and to say that there should be those are maybe someone will stand up a separate entity, but generally you have your activities-based regulators, your functional regulators, SEC and Cbdc, and then you've got your state regulators, your state chartering authorities, federal chartering authority, the FDIC, the Fed, and they're pretty much all involved in just about everything. So the thought that we would peel that back and have a main regulator is probably a little bit off base, right? At the very least, some folks look at this and say, well, couldn't we combine the CFTC and the SEC, and then they would fight? Great point. However, they're overseen by separate committees in Congress, and the congressional committees are a little bit hesitant to see forward. Let's see, and then what is acting like the Federal Reserve Bank for digital assets? Great question, right? So who manages supply of digital assets is that question, and that's going to, the answer is of course going to depend. It will depend on the asset. In the case of Bitcoin, the supply is fixed and managed by the code that governs the Bitcoin blockchain, right? The supply of total Bitcoin is fixed at 21 million. The last Bitcoin will be issued, and at that point, the supply will be capped, and the incentives to validate transactions will be given by the proof of work that's necessary to validate the transaction. So you'll pay fees on it. Other digital assets are governed differently. Some are managed by a foundation. Some have a fixed supply that an entity manages through release and repurchase, right? In some cases, it could be a function of demand, right? In the case of stablecoins, right? So who manages the supply of stablecoins? Really, it's those entities that issue them, and of course in conjunction with banks that hold them in reserve. So in that case, ultimately, if a stable coin is reserving its, is backing its issuances one-to-one with fiat, right? Fiat is managed by the Federal Reserve, then the Federal Reserve is also indirectly managing the floating stable coin, right? And I will endeavor to get copies of the slides out. Okay, I'm gonna move on to the next slide here. So really important concept, right, for digital asset custody, right, is hot storage versus cold storage. Want to make sure we have time for Roberto to talk. So the key takeaway here, the way to think about hot storage and cold storage is, your digital assets are stored in kind of the functional equivalent of either a bank vault, right? You walk into the bank, there's a lot of money in the vault, or at the counter, right, at the teller. There are probably a bunch of folks on here who've never, been into a bank. Trust me on this. There used to be these things called bank branches where you would walk in, there's somebody at a counter, usually behind, bulletproof glass, who would, take a check that you would write, put it, in a drawer, take out some cash, right? So there's, a certain amount of what the bank holds is held readily accessible and accessible to the public, right? And a certain amount of it is held in reserve behind, in a vault somewhere, right? Behind several locks and keys, several feet of, steel, concrete, etc. That's the way to think about the difference between hot storage and cold storage, right? So hot storage is accessible to the internet. Cold storage is generally, held offline, right? Unless subject to compromise. When we think about the, 100 billion in losses, the vast majority of those are because hot wallets compromised. Somebody got the password to my exchange account, right? Went in, moved the assets, right? Or realized that there was a way, because of lax security controls, to access the entire hot wallet. Basically, key to the side of the bank that lets them in. They can raid all of the the tellers' drawers. See a couple questions in the chat here. It looks like we don't have questions. Okay. Pause there, see if there are any before I move on. Okay, Roberto, I think we had another question here. Another polling question.
Okay, I'm launching the next polling question.
So, true or false? Crypto is not regulated. Great participation here. Looks like we are just at about 75%, right? And it looks like we're really evenly split, right? So, yep. So crypto is not regulated. True or false? Crypto is so the markets are not regulated. So I'm going to have to give like half credit here. I'm going to say the markets are not regulated, but crypto providers are, right? And this slide here looks at those various regulatory forms, right? So from left to right, we have the various regulatory options. So this is important because this is going to be who you would face off against in selecting a service provider. All right, the slide that we kind of breezed over really talked about that whole build, buy, or rent. On the left-hand side, right, in the numeric majority here, we have MSBs, right? So money service businesses, wallet providers. These are not qualified custodians for the purposes of the 40 Act, right? So if you're an institutional investor, right, you can't really store client funds. If you're an individual or a corporate, though, that you don't have the regulatory constraints on where you can store your assets. You probably can, right? So think of this as the crypto equivalent of PayPal or your Venmo wallet, right? Regulatory framework. So that's the state licensing as required by state law and the federal FinCEN registration. And then at the bottom here, right, as compliance professionals, this is where we want to have a little bit of time, right? You have the regulatory regimes that come along with that, right? And so, think about it like this, right? All of what we have on the bottom, right? The Bank Secrecy Act, Anti-Money Laundering Examination, the FFIEC, IT handbook booklets, right? Specifically the Business Continuity Management Act. Those constitute kind of the core supervisory expectations, right? Those would be, the index of regulatory obligations that your service providers would need to fulfill, or indeed if you were looking to get into providing crypto services, what you would have to anticipate, moving into complying, right? So that would be your index of regulatory obligations, right? There are some broker dealers that are active, right? As we talked about, there are, there's a school of thought that says that many of the, digital assets out there might be securities. So a number of broker dealers got into security, got into crypto. Many of them hold dual licenses, right? So they'll hold a broker dealer license, and they'll also hold the money transmission license just to cover their base, right? So that makes them subject to not only examination by typically state banking examiners, crypto-specific money transmission examiners, but also FINRA and oversight by the SEC. We next have the state trusts, right? The state trusts are creatures of state law. They can act as qualified custodians, right? And each of them generally tries to abide by federal FFIEC standards for examination. In a lot of instances, publish the specific requirements that they examine against. With any state regulated entity, there may be state specific requirements, right? So New York has a number of state specific requirements around AML, but also InfoSec, right? There's a particular regulation, Part 500, which requires regular penetration testing, vulnerability scans, disaster recovery testing, 72-hour notification of cybersecurity events, right? There's also an internal audit expectation that aligns with the way that regulators examine and rate some of these entities. So there's a couple questions that relate to cold and hot storage. So there's a question about a specific provider, rather than answer for a particular company. What I'm going to say is that providers make use of a range of hot and cold wallet, typically hot and cold wallet, storage capabilities. And because the hot wallet is uniquely accessible and vulnerable to bad actors, they tend to try to minimize that. Where there are regulatory expectations around hot and cold wallet, the regulatory expectation is also that that most client assets would be held in cold storage because it's safe, right? How are keys in cold wallets accessed or cold storage? Keys physically transported for ownership change? Well, the keys are basically just stored offline, right? Prohibiting remote access, right? Oftentimes they're literally held in vaults, right? Subject to, in some cases, those keys are held in shards, right? So you can have one key that's that long, right? I break it up into a number of shards such that I require 3 out of 4, or X over N pieces to be able to use. How likely or how soon is it the Fed will grant charters for currencies? Is it reasonable to think that this will happen? This is a great question to move the left of the slide to the right. As I mentioned, the OCC has stated that crypto service division is national banks, and over the summer, prior summer, issued a number of opinions stating that was the case, and granted a number of charters in the space, right? I think 2 of them were conversions of state chartered entities to federal trusts, and one of them was what we call it de novo, right? So an existing trust company, state trust company, said we want to form a new trust company to do substantially the same business, but as a federally chartered entity. OCC granted that approval as well. To date, there's been no public approval of crypto activities for depository institutions, right? So traditional banks, right? Trust is different from a bank, that it doesn't take deposits and make loans and hold funds in custody, but it's not a deposit taking institution. A bank, in the sense of the right-hand column here, as a deposit-taking and loan-making institution. And although the legal authority for that is given, there haven't been any public approvals yet. In fact, there's since been a change at the top of the OCC. The crypto approvals and opinions were issued under the prior administration. The current administration has said, yes, but you have to get supervisory approval. There's been no public acknowledgement of any supervisory approval given there yet. So you can get it from your bank. You probably haven't gotten it yet. So one more question. I'm still not clear whether cryptocurrency is regulated or not. Could you please clarify one more time? Thank you. This question could just as easily have been written by the general counsel of the cryptocurrency company. So it's a great question. And I'm going to say, as a prior regulator, right, I have two views here. Yes, cryptocurrency activity is definitely regulated, right? But it's in no way, shape, or form as clear as the way that money transmission is regulated, or the other core banking activities, right? What we haven't had yet. I've mentioned a couple times the FFIEC, the Federal Financial Institutions Examination Council. So that's the Federal Reserve, the OCC, the Federal Deposit Insurance Corporation, and the credit unions and states and the CFPB. What we haven't had yet is one single voice that says, in the United States, this is how crypto should be regulated. What instead we have is, really a patchwork of regulation, and the extent to which any activity or entity may be regulated is really a function of what kind of services it's providing, and also where it operates, right? So, public record, the state of Montana does not regulate money transmission. There is no law on the books in Montana to regulate money transmission, right? It's just not something that we do, right? So you can do money transmission in Montana without a license, right? The state of California has decided that it wants to foster and promote virtual currency business activity, and so it is, it's taken the posture that it's not going to require licenses of crypto activity, right? New York, on the other side of the country and on the other end of the spectrum, has said to do crypto in New York, you need a specific license that's separate from the money transmission license. And oh, by the way, you probably also need a money transmission license. So a lot of entities in New York will hold two. Some entities some entities operating in the United States will hold multiple licenses. A New York entity will probably have to hold two. Someone in Montana or California may not need to hold any, and someone in a state like Illinois may just need to hold a money. Yep, I would agree. Someone has written in Q&A, crypto is minimally regulated compared to what the U.S. calls a regulated financial industry, right? From one standpoint, I would agree to it with that statement. The other standpoint, there are a number of crypto service providers who hold upwards of 30 MSB money transmitter licenses, right? And so they may constantly have examiners from several states on site, right? So it's really hard, to go to the CEO of a reputable crypto exchange who holds 32 licenses, say, you're not regulated. She's going to point next door to her conference room where you've got, an examination team made up of participants from, 5 or 6 states, and say, you're telling me that these guys, don't exist, right? We'll have an interesting conversation. Okay, if a person is using a certain service provider for buying, selling crypto by a mobile app and are based out of New York, will they have to have a license? I'm trying to understand how granular the crypto license is. So typically, I'll use the the example of New York. New York says in order to serve a New York person, that's defined in the reg, then you need to be licensed in New York, right? So if I'm a New York person, right, and it's a little bit gray as to whether or not if I have, you know, my tax ID and hold my assets, you know, for instance, in Florida, right, and spend some time of the year in New York, if I qualify as a New York person, if I'm just transiting from LaGuardia, we're not, you know, generally, you know, you go through KYC, you know your customer, right, and customer onboarding on the basis of, you know, government identification that establishes who you are, right? If my documentation is Florida documentation, right? You know, I live in Florida by the Sea. I register with Coinbase. There, I receive all my tax, you know, and you know, other you know, other you know, financial you know, dealings there in as a Florida resident. I qualify as a resident of Florida, probably for purposes of the New York reg. The little bit gray, if I'm sitting in LaGuardia and I want to trade on my Coinbase app, I can probably, you know, that's probably not something that in practice anyone is going to, you know, deny. You know, entities that are regulated, right, and may not hold a New York license, right, or where there are, you know, state-specific considerations, will generally use, you know, geolocation and may use geo-blocking, right, may even block certain VPNs. So if you are a Florida resident and you have an account on an exchange that is, you know, licensed to operate in the state of Florida, you're transiting through, you know, New York on your, you know, your way somewhere else, you know, you may or may not be able to make that trade until such time as you know, get to a place where they don't have those concerns. How does the public know who is adequately regulated? So I think that's, you know, one of our last slides here. The National Multi-State Licensing System maintains a database of crypto enterprises and where they are regulated. It basically is the place where all the state regulators come in and you know, will come in and you know, log in one instance, right, in one location, you know, where you know, where licenses are held. It's pretty good. It's if you don't see your particular state on there, I would say just double check on the state website. It doesn't always flow through as it should, right? So I think that brings me to kind of my last question, right? Want to learn more? Here's resources, right? And we'll include the links, you know, the materials, send them out. So I warned you guys, as a former regulator, I could go on and on. I haven't, you know, Rob, I know I hope we still have some time for you. I haven't had anyone tell me to, you know, to yield before. But with that, I think, Rob, Roberto, what I would do is yield the mic to you.
Awesome. Thanks so much, Robert, for an extraordinarily informative presentation. That is fantastic. I can't tell you how excited it makes me to see the audience getting the chance to ask these types of questions, to have these questions answered for them, and to be able to you know, be exposed to subject matter expertise and these thoughts and opinions. So it's really fantastic, and I just can't thank you enough, Robert, for your presentation. So what I'm going to do real quick is actually kind of discuss the formatting and schedule for just a moment, and then talk about some sponsors and stuff like that. So we were scheduled to go today until 1:30. What I'm going to do is I'm going to go just a little bit beyond that, in case anybody is interested in hearing the discussion about building a Bitcoin company in a Bitcoin nation. Originally, this slot was scheduled for a delegate from the El Salvador administration, which we're very excited to hear from. Unfortunately, as delegates sometimes get, she was called away at the last minute to do something else. So we had specifically asked Robert Donovan to expand on his presentation as much as possible, and we're very grateful that he did exactly that. So if anybody does need to drop off at 1:30, believe me, by all means, we understand. Just in case anybody wants to stick around and hear the additional presentation, I'll probably go until a few minutes before 2 or sooner than that, just depending on how fast we can get through this presentation. But before I do any of that, what I want to make sure that we definitely mention is thank you very much for participating in this webinar from ISACA South Florida. We are more than 1,200 members in South Florida, and so we're thrilled to have you on, and we're thrilled that you're participating in educational content like this. If this is something that appeals to you in a strong way, educating the community, contributing to thought leadership, and engaging with peers, then by all means, our nominations are open right now, so you can submit a self-nomination form to join the board. There's more information about what's involved with that on our website, ISACASFL.org, or this long link that I have written here. And you can definitely go and check that out and submit an application. You can also just Google ISACA South Florida and you'll be able to pull up our website. Also, very exciting is that the WOW event has been sponsored by Audit Board and 24/7 Security. For today, Audit Board has actually given us the opportunity to do a raffle. So I'm going to real quick share that link in the chat in case anybody wants to participate in this raffle. So that link is now in your chat. It's a hyperlink. You can go on there. I'll pull it up so that you can see this is not a phishing email, right? This is a site that you will be submitting your contact information directly to Audit Board, and that is in exchange for a chance to win a pair of Apple AirPods, which are pretty awesome. I think that's a fantastic promotional offering that they're giving us. So please, by all means, click that link, go visit. Audit Board's a fantastic partner for ISACA South Florida, so we're thrilled to have them supporting this chapter once again. So please go ahead and do that at your convenience. And then what I'll go ahead and do is kind of hop into the second discussion that we were talking about today, because today's theme is cryptocurrency adoption and all the complication and governance risk compliance that involves. Then I'm going to be talking a little bit about building a Bitcoin business in a Bitcoin nation. And just to give you some idea of why I'll be talking about that topic, I currently am serving as the Director of Operations for an open source software company. It's called Galoy, and it basically builds what's sometimes called core banking software. So you could think of that as the type of software that banks use to keep track of everybody's accounts and offer products and services. We build core banking software on the Bitcoin network, and especially on the Lightning Network. So that's why I'm going to talk a little bit about what's going on with some of the things that we did down in El Salvador, and how we're dealing with some of the risk and opportunity and compliance obligations that are down there. I also am an adjunct professor at Florida Atlantic University, go Owls, and I have the pleasure of serving as the president of ISACA South Florida. So now you have some idea of where some of my perspectives come from. In this very brief conversation, what we're going to do is talk a little bit about some early lessons learned from building a Bitcoin business, actually in El Salvador, and where Bitcoin is legal tender, and we'll talk about that. We'll talk a little bit about the compliance requirements for Bitcoin businesses down in El Salvador, and how those are starting to be built out and understood, some of the similarities and differences of things that we're seeing down there. And then finally, we'll talk just a little bit about risk and opportunity for Bitcoin businesses in general. Now, I'm saying Bitcoin because that's the network that Galoy actually builds on, and Bitcoin in the Lightning Network. However, there are certain areas of overlap and certain areas of similarity with cryptocurrency in general. I'll try and point some of those things out so that you can have in your mind a distinction between what I'm talking about Bitcoin specifically and cryptocurrency generally, because many of these topics apply actually across the board. So what is going on in El Salvador that people ended up using cryptocurrency, Bitcoin specifically, and what is going on that the government actually ended up making Bitcoin legal tender. Let's talk about that. So El Salvador is a nation that actually has some interesting challenges, but it turns out that these are challenges that are present actually throughout the world. And so let's talk just a little bit about the challenge of financial access. So globally, about a third of adults in the planet, 1.7 billion people, are basically unbanked. And this information is sourced. That asterisk is for a source, but basically that means that they don't have access to a bank account or a typical type of transactional account, right? So these are people who live their lives probably mostly dealing with cash. So it's probably a paper currency and or coins that they deal with. And when you think about the magnitude of that problem, a third of the adults on the planet are unbanked. And then the amount of people who are also underbanked, maybe they have limited access to financial accounts and financial resources and financial networks, then you start to gain an appreciation for something that we very rarely see in the professional environment in the United States. So around the planet, this is an enormous problem. Half of those unbanked people are women and poor households and people out of work. So this challenge is especially acute for those who often traditionally have had limited access to financial resources. So it just makes it even worse for them. Many unbanked individuals actually lack the necessary identification to get a bank account. You can think of a farmer in Africa, you can think of a laborer in South America, you can think of a migrant worker in Asia, and this person may not necessarily have all the documentation that's necessary to open a bank account. Here in the United States, it turns out by comparison, sometimes you can open a bank account with very little information compared to what is necessary in other countries. So trying to set the context just a little bit so you can maybe appreciate some of the differences. This is probably, for anybody on this webinar, this is a very foreign challenge, not something you experience personally. So it's something that I want to make sure that I kind of communicate to you the magnitude and the severity of this issue. Also, lack of access to a bank account, it actually makes saving extremely challenging, sometimes very dangerous. If you don't have a bank account or some kind of financial transaction account, and chances are you're taking cash and you're hiding it in one of three places: on your home, on your person, or in your car. And each one of those places presents a certain type of danger when you start trying to hoard cash in any of those places. So there's a level of danger associated, there's a certain limit in the amounts that can be retained. And as a result of that, there's a certain sort of mobility limitation that a person can't even really save up and work towards something better because they don't have access to those types of accounts. So these statistics that I've been talking about are global. In El Salvador, 70% of adults have been unbanked for the past few years. And additionally, on top of that, El Salvador receives 20% of its gross domestic product, about $5 billion, 20% of the GDP, as remittances. That's typically people who live in the United States and send money back home to El Salvador. That's how they're getting a fifth of their entire GDP, right? So when you start to think about the fact that those transmissions oftentimes involve someone needing to go to a Western Union. And what if they live in a town that doesn't have a Western Union? They got to ride a bus for maybe an hour or 2 hours, go to the Western Union. Maybe they're receiving $50, $100, $10, and then some of that money's taken away in fees. Typically, it's 5 to 10% that's taken away in fees. And then they take the bus back to their location. You can see how an entire nation that is facing this challenge would be looking for creative solutions through financial technology, through fintech, right? And so that's what El Salvador found itself faced with when they were kind of thinking about this problem. And there's a specific community that especially decided to attempt to perform a bit of a social experiment. This community is in a beach. It's called El Sonte, which is in the southern coast of El Salvador. And this community now is oftentimes referred to as Bitcoin Beach. But originally there was just mission, a sort of local not-for-profit that helped people, that taught children and that taught English classes and these kinds of things. And they received an anonymous donation in Bitcoin. And the one restriction on the donation was that they couldn't convert that Bitcoin into cash. They couldn't convert it into US dollars. Instead, they had to actually reinvest this donation as Bitcoin. And it was multi-six-figure donation. So they were well incentivized to attempt to do this. And they knew that they were going to use the funds in youth work programs, educational grants for people, transportation for children to school, helping people buy food, constructing homes and other types of city infrastructure, and helping people pay utilities. And in order to do that, they started using Bitcoin wallets and basically trying to teach people how to use these kinds of wallets and transacting with traditional Bitcoin on chain for the most part, sometimes using a technology called the wallet of Satoshi. But what they found is that on-chain confirmations, the amount of time it takes to get a confirmation that the money was sent from one wallet, received to another, that those happen every 10 minutes on the Bitcoin layer 1 network. And so they saw that there was a little bit of time delay there. They also saw that if you want to send really, really small amounts, well, there's an actual transfer fee. And so sometimes when you got a really small amount in your wallet, like $1 or 50 cents, now you can't even spend it because you can't cover the transfer fee. So they ended up dealing with something called dust. They found that self-custody is highly technical. You heard Robert Donovan talking about people holding their own private keys and storing those and writing them down and seed phrases and those kinds of things. A lot of times, people who have never been exposed to bank accounts and they live in this surfing village that's beautiful, but they never necessarily have been exposed to a lot of technology. That's something that's very foreign to them. And then additionally, just general matters of education around what is cryptocurrency, what is Bitcoin, was challenging. Dealing with converting Bitcoin in your head to dollars, or having a calculator or a pencil, or being able to check markets. And then also, if there's not enough people accepting Bitcoin, then, it presents a challenge to the community to attempt to invest in the community using Bitcoin. So they were faced with all of this. And then someone named Nicolas Berthet, one of the co-founders of Galoy, actually read about some of these challenges they were facing. And so he went down to El Salvador, to El Sonte, and he decides to build a proof of concept, a digital wallet specifically for them. He was already working on the core banking software built on the Bitcoin network. And he says to himself, I want to build a proof of concept specifically for this community. So use the core system for this community as their community bank, and then also create a special wallet specifically designed for the people in this community, and have it, show their local map, show each other who are accepting, show all the vendors who are accepting Bitcoin, have it run on Lightning instead of on chain, because Lightning transactions are basically instantaneous and almost free. Oftentimes a fraction of a penny is the transfer cost. Make sure that it was clear and intuitive, make sure it included information not only about Bitcoin values, but the exchange rate with the US dollar, because El Salvador is a dollarized economy and they're trying to think in terms of dollars in terms of cost. So he goes down there, he builds this proof of concept, and they start using it and really educating the community and learning all these lessons. And there's a lot of lessons that were learned in the process, and I won't necessarily go into all of them. But at a high level, what they saw is that educating people on what cryptocurrency is, specifically what Bitcoin is really the paramount issue to this entire thing. And there's a couple of interesting salient points that come out of that. And that is, number one, they started off trying to educate the adults. It turns out it was very hard to educate adults, but then they moved to the kids, and the kids picked it up instantaneously and then taught their parents about it. So great takeaway from that. Number two, when they actually put a Bitcoin ATM in this village down there, then people were able to go over to that ATM and, if they wanted to, take out paper currency as US dollars, so they could trade Satoshi or small fractions of a Bitcoin for dollars. And once they saw that they could trade that amount in their digital wallet for physical paper dollars, it suddenly became very real to the people in this community. So that helped a lot with education. Another lesson that came away is that Lightning Network, because it's instantaneous, because the transactions are almost free, it really changes Bitcoin in people's minds from being a way of storing value to an actual medium of exchange. What we oftentimes kind of intuitively think of as money. I pay for this, I pay you 50 cents for a cup of coffee, I pay you 25 cents for a mango, I pay you $1.50 for some eggs and milk down there. And so they saw that Lightning Network really made an enormous difference in this community's adoption of Bitcoin as money. And then they found that by onboarding merchants first and getting the merchants to accept Bitcoin as payment, that it really created this sort of centers of influence that people were actually, they saw they could go ahead and spend their Bitcoin throughout the community. So there's a woman in this picture right here. Her name is Mama Rosa. She makes a really fantastic bunch of dishes, food down there, and she was the first merchant in this village to accept Bitcoin as payment. So they saw that by getting the merchants to accept it, it really helped accelerate things. Additionally, they saw that user experience is highly cultural, right? So there are things that maybe here in the US, we discuss topics about Bitcoin and cryptocurrency and, you know, decentralization and blockchain and NFTs and all these kinds of things. And in this area of El Salvador, where they were actually using Bitcoin on a day-to-day basis as money for their local circular economy, they weren't interested in a lot of those theoretical concepts. They weren't interested in a lot of concepts about the Fed. They weren't interested in a lot of concepts about how does a blockchain work and immutability and these kinds of things. They were just really interested in a lot more hands-on types of transactional matters. And so they found that by onboarding people, a lot of times it's better to show people how to just use it. In other words, just give them a few Satoshi, you know, small fractions of a Bitcoin, and then just have them pass it around to one another. Have them send 50 cents to this person, send 50 cents to that person. They found that by putting the vendors on maps, it showed where you could go spend it. So it made it a lot more fluid, and it made it a more native and intuitive experience. They found that by putting in just very small comments in the payments, now people could scroll through their history and have really good context for the payments that they made. Oh yeah, that was when I bought coconut. That was when I bought you know, some bread, that sort of thing. So you know, and all this of course is in Spanish since it's down there in El Salvador. So they found that there were a lot of user experience phenomena that were highly culturally oriented. And then one of the biggest lessons that came out of this entire proof of concept project is that custody is actually something that's a bit more on a spectrum than we sometimes think about. A lot of times in terms of cryptocurrency, we talk about self-custody, we talk about custodians. You know, self-custody, I have my own private keys. Maybe I have it in my phone, or I have it on a paper wallet, or I have it in, you know, some kind of ledger device. And then we talk about custodial services. Maybe I have cryptocurrency in Coinbase, or I have it in Gemini or Kraken or Binance, one of those places. But there are models in between self-custody and the full custodial accounts. And that's something called community custody. And what we did, without getting too technical down there in that proof of concept, is they created a community custody model where there's basically a multi-signature wallet, and that means that more than one person has to get together in order to authorize the movement of the funds that are in the reserve, right? And the same way that your bank sends around funds from reserve, more than one person and multiple people who are known and trusted to the community, those are people who can move the entire reserves for the community accounts. And then everybody else is basically just treating that community account as a custodian, right? And so in theory, this collective community is self-custodial. They actually hold their own keys through a few community leaders that hold private keys in a multi-signature wallet. So it's not custodial in the sense that somebody like Coinbase or Kraken or Binance holds the keys. The community holds it. However, there are multiple people in the community who all need to act together in order to perform some kind of very large transaction with the reserves of all those shared assets. And that community custody, it turned out to be very, very powerful for enabling this community to hold its own keys and be self-custodial, but not have every single individual user tracking private keys and backing it up and writing down seed phrases and all the kinds of technical things that sometimes people have to deal with when they're working with self custody. So community custody became a very effective model. Turns out the reputation of this community down there in El Salvador spread very quickly and became known, so that by the time of June 2021, this actual proof of concept and this village that had created the circular economy had worked its way all the way to the administration of the president's office of the nation. And they announced that they were going to create La Ley Bitcoin, or the Bitcoin law, which makes Bitcoin legal tender throughout the entire nation. They announced that in June of 2021. And then in August of 2021, the central bank actually provides technical standards for how to implement La Ley Bitcoin, the Bitcoin law. So they produced a document for facilitating the application or the implementation of the law, which is 25 pages. They produced another technical document specifically for authorization of digital wallet platforms, another 9 pages. And in them are buried many of the types of compliance requirements exactly that you would expect to be present when talking about these types of financial services, right? They say that in Article 5, they say you have to have an AML program. They go through a lot of details and what must be involved in that program, talk about policies and procedures, contingencies, business continuity plans, backups for 15 years of transactions, monitoring software. If you're in the financial services industry, you know very well about transaction monitoring and all the due diligence that is required for that. They've required certain types of user disclosures for the sake of public benefit and safety of people using it. And then, you know, due diligence specifications became very robust. This is what we normally think of as KYC, right? Knowing your customer. And they built out a very large document about exactly the requirements necessary for knowing your customer, that you need to identify your client through specific documents, you need to authenticate those documents, you need to do a risk-based profile of that customer to better understand their transactions, those kinds of things. So, so far, feeling very, very traditional in terms of compliance. Then you get into some additional requirements from the central bank. Traceability. This is something that you absolutely would see in traditional financial banking, that you need to be able to identify the originator of a transaction, who's the beneficiary, you know, who's sending the money, who's it going to, and you need to be able to know a bunch of stuff about them. This actually can start to get very complicated when you bring in Bitcoin technology and or blockchain technology, and even more complicated when you bring in the Lightning Network. So Bitcoin is a fully public ledger. If you do have the opportunity to associate someone's identity to a specific address, from that point on, you're able to identify somebody according to the address. Lightning Network, it's not the same. Lightning Network is obscured, and that type of information is not present. You cannot see all of that on the public blockchain. So as far as the fulfilling traceability requirements for the Lightning Network, which is actually how Bitcoin is being used very much in El Salvador, it starts to get a lot more complicated than that. Additionally, in Article 51, they talk about other information that needs to be stored and recorded and maintained for all different types of transactions, so that, you know, banking regulators, which down there, for example, the central bank and the basically what's called the superintendent of financial services in Spanish, are the regulators that will oversee these types of entities, and they will come in and ask for this type of information according to their understanding of the standards and according to the implementation requirements that were produced by the central bank down there. So next month after that, September 7th arrives, Bitcoin Day. El Salvador becomes the first country to adopt Bitcoin as legal tender, and all that involves. And then you have a lot of Bitcoin companies setting up presence in El Salvador, a lot of them working through some of these matters. The proof of concept that Galoy created actually ended up getting spun off as a separate entity, so that now it's turning into what we would effectively call a neobank, right? A depository institution that is mobile first, and that it doesn't really have branches or any types of traditional brick and mortar operations. And all these companies, not only the Bitcoin Beach Wallet company, but companies like Paxful and Strike and other types of companies down there, are going through and dealing with the reality of establishing a Bitcoin company in a Bitcoin nation. They're working through traditional financial products like bill pay services, remittance services, merchant services and POS, and then they're working through non-traditional financial products and services like, you know, micro payments and additional types of interface and educational types of products that are built on top of these digital wallets, and then also messaging services and other types of apps that are built on top of these networks, these crypto networks, or specifically the Bitcoin and Lightning network down there. And then these companies are oftentimes faced with the interesting aspect of a hybrid Bitcoin and fiat operations, right? So at the company that I work, we pay many different people all around the world in Bitcoin, and we do it on a daily basis. This is daily operations for us. And so, whereas on the occasions when I have to send a wire transfer internationally, I have to fill out a lot of form. I have to gather people's information. I have to provide, a lot of information and context around this transaction, and then send that. And then a lot of times I'm confirming, or that person is confirming with me, back and forth, that it was sent. We get confirmations. We wait 5, 10, sometimes 15, sometimes 20 days. These things get held up in the networks. Sometimes they're held up by the banks. Sometimes you don't know why it's being held up. Sometimes it's in a correspondent bank and they're not giving you information. Or you send that through Bitcoin and it settles within a matter of minutes. So, this is a very different reality for global, borderless, international businesses. Galoy actually has 17 employees in 12 different countries. So there's a lot of payments being made all around the world on a pretty ongoing basis. Additionally, there's a very interesting aspect of the reality of transparency in transactions, right? You can create, and people often do, create unique wallet addresses for every single transaction. And then, if you have several people that are monitoring the transaction, they can all just check on the public blockchain using a blockchain explorer. They can check that address, right? So let's say that you need to pay some vendor and someone else in the company has asked you, and you've gone ahead and asked someone to authorize the payment, and then the Bitcoin is sent. Well, anybody in the entire company who had in that chain of communication, from the vendor themselves to the person who requested it, to the approver, to the record keeper, everybody who has that address can just hop into the public blockchain, see if it's been paid, see exactly when it was paid, see if it moved after it was paid, all these kinds of things. You also face finality in transactions, right? Once the money is gone, there is no customer support to call, right? There's no central bank, there's no ACH reversal, there's no wire retrieval, there's no one to, to help if something like this is sent to the wrong destination. So that finality is definitely something that makes it safer for vendors who are worried about chargebacks, and also more risky for people who accidentally send money to the wrong place, right? That's a two-edged sword, very interesting aspect of a blockchain. And then there's evolving compliance programs, right? I referred a little bit to traceability being an interesting aspect. There are a lot of instances where there are compliance officers and or equivalents, entire compliance teams that are working to map what is oftentimes phrased as very traditional AML programs and transaction monitoring and KYC checks and these kinds of things, know your customer types of activities. And they're mapping that onto the new landscape of blockchain and the Lightning Network. And not everything maps one-to-one. Traceability is the area where I specifically pointed out, but there are other areas as well. And then, of course, certain companies that are involved in this, since they're financial fintechs, they're seeking compliance certification, maybe SOC 2, maybe ISO. Actually, a lot of things are very similar for these companies with traditional fintechs. There's just specific aspects relevant to like custody and authorization. I referred earlier to multi-signature wallets. And Galoy is actually an open source software that you can go see exactly how it works on GitHub right now. Those types of multi-signature things. Multi-signature is not something that exists in traditional finance. The closest thing would be, multiple people authorizing a transaction, but they don't all need to necessarily produce a key in order to get that sort of thing done. And then how you deal with handing off those keys after certain people, let's say, leave the company or pass on, can be a little bit more complex than in traditional finance, where you maybe just change the user authorization in a software module. So people are Bitcoin companies are dealing with those types of reality, and along the way, they're also providing new types of assurance. The original Bitcoin white paper was produced basically to answer a couple of very interesting problems of trust. Something really interesting to us as auditors, primarily that central banks will be trusted not to inflate your currency's value away, and that banks will be trusted to transfer on your behalf. There's a pretty interesting and active conversation going on right now in public discourse about our Federal Reserve and its monetary policy and whether or not they are inflating certain value away. And then there's interesting conversations going on in Canada about freezing of assets and accounts of people who are involved in certain public protests and certain peaceful demonstrations. And some of those people are having their accounts frozen and their accounts and their assets restricted. And so Bitcoin will be a network that does have the capability to be resistant to those types of threats. Along with that, Bitcoin also has certain types of risks that are unique to it. We don't really have time to go into a discussion of some of these things, but let's say that that bugs were found in the code, highly unlikely because it's been public open source for 13 years now, and people attack it all the time, or that there's a state attack, or that miners centralize, or that you use a custodian and for some reason they don't transfer or conduct your assets in the way you want, or other issues as well can present risks to Bitcoin. But there's also expanding opportunities in this landscape as well. So embedded finance is the use of technology to bring financial products and services and brands that were not traditionally, financial services companies. Starbucks app, Peloton with their Affirm lease to own services, Uber giving their drivers credit cards, Stash helping people invest through just an app, not a traditional bank, or Metromile helping people insure through just an app. Lots of interesting innovation. It'll be interesting to see how cryptocurrency and Bitcoin change those types of landscapes. So I know that was a little bit of a fast conversation. I probably always try to cover too much, so I apologize for that. But I'd be interested in staying in touch and look forward to the opportunity to continue this type of conversation. So there's a few questions in here that I see. Will the presentation be available? Why is unbanked a problem? Those kinds of things. I will make the presentation available on the ISACASFL Florida website. Happy to share it. Thank you, Robert Donovan, for doing the same. Then we look forward to continuing this conversation. So let's talk just a little bit about some ISACA stuff before we wrap up. And that is that the CPE certificates will be sent out within approximately 1 to 2 weeks of this event finishing. Your Zoom activities, in other words, the fact that you're logged in is what's used as evidence, not any types of polling questions. So if you were logged in through Zoom, then you will be receiving a CPE certificate, and those will be going out to you. If you attend one day, you'll get the credit for one day. If you attend two, you get credit for two. If you attend all three, you get credit for all three. And thank you very much for joining us for this ISACA South Florida presentation. It's our pleasure to have you. Please join us tomorrow as we talk about the future of work, and look forward to an excellent presentation from FedEx, from a former CISO at WeWork, and from a specialist researcher who specifically is doing a lot of interesting research in the future of work. So 12 p.m. Eastern tomorrow, join us then. Have a fantastic afternoon, everyone. Thank you very much for joining us.